I think I'm going to try doing everything now. I want to
Just to let you know the tasks for this week, please bring your assessment 5 script to the task class, as well as the assessment 5 task exercise and the solution, which you can find in the test and feedback folder. So it's your choice to bring it either in a hard or soft copy. We will be working through that in a very systematic way in the task classes. As you know, then we will have the remarks Friday at 10 o'clock. The remarks must be in, so we're giving everyone a chance to work through their scripts. The reason for working through the scripts in the tasks is not to find marks, but if you do find them, we're giving you ample opportunity to bring them in. Okay. And then I did a video on the class example that we did not get to on Thursday. So the class example is there, as well as the video of how to go about it, and then there's a solution with some extra comments in that as well. So that's all in the class notes section of the IS8 learning module. Okay. Right, then today we are doing cash flow statements. And I do hope that you did a little bit of revision so that when you're going to do this class example, you understand and you're with me and you know the format of a cash flow. If you have not worked through all the information that is there in the cash flow learning module on Blackboard, then I suggest that you do that as soon as possible. So that's basically your revision in terms of cash flow statements, which you've done it extensively in Accounting 100. We are just building on that for this year. So we are just this year basically incorporating everything that we have done in a cash flow statement. So that question of how I'm going to test the first semester work, this is one way. I'm going to test it within a cash flow statement. Okay, so and that means that you really need to know what is going on in the topic to be able to do the cash flow statement. Okay. Before we start with the question, I just want to highlight the formats. It is in that learning module as well. But I just want to show you the differences here. Last year you did the direct method. Okay. Without you did the direct method. But there is actually two methods to prepare the cash flow statement. There's the direct method and there's an indirect method. Now the direct method directly starts with cash flow. That's the direct method. So the moment you start, you have cash receipts from customers. So you start with cash amounts and it's cash amounts throughout. The indirect method starts with a profit figure and from there it adjusts that profit figure to get to a cash flow figure. Okay. Now what you did last year is you did the direct method and you did cash receipts from customers and that was a calculation that you've done. And then you did, you had in cash paid to suppliers, employees. But then what you did is you calculated cash generated from operations through a note that you did. Can you remember that? Okay. So, and then the cash paid to suppliers and employees, that was a balancing figure that you had. Now, the note that you did was this, what I have here on the right hand side. You started with profit before tax in that note and you adjusted the profit before tax. Basically for three groups of things. Firstly, for items appearing later. Okay, so they appear on their own at the bottom there in the after cash generated from operations. So we just need to adjust them now when we're starting with profit before tax. Then we have all our non-cash flow items. And there are only a few examples like depreciation, your profit and loss on sale of assets, impairment losses, fair value adjustments on investments. That's something new that we did this year that will go in there. And then lastly, we go and adjust it for working capital changes. So that's when we look at our inventories, our trade receivables, and our trade payables, and we do the increase or the decrease of that. Okay. So what I'm saying to you is there's actually nothing new for you to go and learn in terms of the format. Because if you are using the direct method, you will do a calculation for cash receipts from customers, but then you will go and do this calculation to get your cash generated from operations. If you're using the indirect method, then you will actually start with that note that you did last year. And this will be then part of your cash flow statement. In the end, they both come out to cash generated from operations. The same thing. So if you're using the one method, you'll get cash generated from operations. The other method, you'll get cash generated from operations. And from there, the cash flow statement looks exactly the same. All got that? You look a little bit bewildered. Okay, nothing to be bewildered about. Okay, so I can either ask you the direct method or the indirect method. If I'm asking you the direct method, you do it exactly like you did last year. You calculate cash receipts from customers, and then you calculate your cash generated from operations. That starts with profit before tax, making those adjustments. If you're doing the indirect method, then you don't have cash generated from operations. You start with that note that you did last year. Profit, adjusting that profit, get cash generated from operations. Cool. Right. Let's do the class example. So this example has a lot of information that we have to work through, and then in the end it asks us to go and do the cash flow according to the indirect method. Okay, so we use that example. Now, a cash flow statement exam technique is different from other things that we have done so far. You have to work through all the information first before you can start with the cash flow statement. Okay. So you need to bear that in mind time-wise. There's a lot of information to go and work through. There's a lot of calculations that you're doing before you're actually starting with the physical cash flow statement and preparing it. But once you have worked through all that information, and if you've made good notes for yourself, like I'm going to show you now, then actually doing the cash flow statement should not take too long because you have all the information, you just put it in the correct format. Okay. When you are doing a cash flow statement, I would suggest that you have a few colored pens with you or highlighters. At least 2 different colored pens or highlighters. What I'm going to do is I'm going to use a blue highlighter for anything where I have to adjust the profit before tax. Okay, so any amount that I'm going to include in that first part, so basically last year's note, where I have to adjust my profit before tax, I'm going to highlight that in blue, and then I'm going to use yellow where it is, okay, let's do rather green. Okay, so green I'm going to do for any cash flow amounts. So once we've determined that this is an amount that must go straight into the cash flow, then I will highlight that in green. The whole thing of a cash flow statement is to work through the statement of financial position, every single line item in the statement of financial position, and you must explain the movement. So as you can see there, we have land. Last year it was 3.3 billion. This year it is 2.550. So I need to explain that movement. I need to say, was this land that I've sold, or was it a part that I've sold, other parts that I've purchased? And therefore you have to work with the balance as well as the additional information the whole time to figure out the balance. Okay. So if we are working here with my land and the difference, I can see that there's a difference there of 750,000. And now I just need to know, was that land that was sold, or is there something else also going on? And therefore I need to go to note 2. In note 2, they say to me, a piece of land was sold for 930,000. So sold for, that means 930,000 is my proceeds, and that would be my cash flow. So that's the amount that I'll put there in as cash flow. And then that sentence further, it says no further sales or purchases of land were made. So that was the only thing that occurred there. But what do I need? Profit on sale. Okay, so I've got the amount of land, the 750, basically my cost, but that I don't need for the cash flow. I need the cash flow amount on that sale, that is that 930, but I must also remember the adjustment for my profit. So that profit on sale, which is a non-cash flow item, which I need to remove. Okay. So to work that out, you take the 930,000 minus the 750,000, and that therefore gives me 180. Okay, so the 180,000 is going to be an adjustment to my profit figure. Okay, so that's land. Then going back, I'm looking at my equipment. So equipment at cost, as you can see there has been an increase there in my equipment amount of 160,000. And there's been an increase in the depreciation of 58,000. But I once again need to know, is that all the movement that have occurred, or is there something else going on? So I need to go to note 2 again. And then it says no equipment was sold during the reporting period. Okay, so that means that movement is the only movement in my equipment. And therefore the 160, okay, so the 160 is a cash flow. Increase my equipment. If nothing further is said, I assume that it is for cash. So I will say to you if it's not for cash, otherwise you assume that it is for cash. So that 160 is cash. The depreciation is a non-cash flow item, so I will adjust my profit before tax with that amount. Then you can see vehicles there. There was no further information regarding vehicles, and therefore it means that the 660 was vehicles that I've acquired, and that's a cash flow item, and the 72 is depreciation, which I will add in with my profit before tax. Okay, then you can see that they don't know what's going on with plant, so we need to go to note 2. And then the third bullet point says, during the current reporting period, Rainbow Limited obtained an additional long-term loan of 1.8. A portion of the loan was used to purchase plant with a cost price of 1.5. The profit for the period correctly includes the depreciation on the plant. At the acquisition date, the useful life of the plant was considered to be 5 years with a residual value of 40,000. But at the end of the year, they revised the residual value to 54,000, and the remaining useful life at that date was again estimated at 5 years. Okay, so because you can see that it's 31st of March and 30th of September, it's within that same year, we just need to go and calculate the depreciation. There's no change in estimate or anything that we will have to go and do. So what is important from this is that this 1.5 is a cash flow. The 1.8 for the loan is also because you're receiving the loan and then you're using that money to go and buy the plant. So the 1.5 is that. And then we just need to go and calculate the depreciation. Okay? You just put the loan in, and the money would be there, and then you use that, so you have 300,000 left. Nothing to change. Okay, all with me so far? Hello? All with me? Yes? I'm going to assume that was a yes. Okay, so what I would suggest that you do is work systematically through everything. So we've done land, we've done equipment, we've done vehicles, we've done plant. Okay, so once we get to physically doing the cash flow statement, we can just go and fill in those amounts. Right. Then the next one that we have is intangible assets. and there's no amounts there, but there's a note, so we will have to go and read through note 3. If you can please read through that note. So something that we probably should have done right at the start was just to get our year right. So we have, it was October 2015 up to 30th September 2016. Okay, so this 1st of November is within our year. So they started with a development and then it bottomed out because of privacy issues. So they had development costs that were capitalized prior to impairment that had a carrying amount of 216,000. So they've incurred those costs throughout the year. They incurred those costs and therefore that would be cash flow, the 260,000. Remember, if I said I assume that it's cash flow unless I say states at something else. So we incurred the cost, but after we've incurred the cost, we have to go and impair that cost because we cannot go further with this development. So we have an impairment amount for the exact same 216,000. And that would go in my adjustments of my profit before tax. Right, the next item on the statement of financial position is your financial assets. So if we have a look there, we see financial assets at fair value, 500,000 last year, 600,000 this year. So we need to go and look what was the movements that have occurred. And they give us more information here, note number 4. They say financial assets comprise shares in various companies, and they classify all these financial assets as financial assets held at fair value to profit and loss. Okay. So please just be careful. Fair value to profit and loss, that's great. The fair value adjustment will go as part of my profit before tax, and that adjustment is a non-cash flow item, so I'll have to go and remove that. When it is fair value through OCI, OCI is after profit before tax. So then you would make no adjustments because it does not affect my profit before tax figure. Okay, and we will do an example now with the debenture with the amortized cost, and we'll see how to do that. Okay, so it says financial assets with a carrying amount of 250,000 was sold at a profit of 74,900. So when you're selling something, what do you need? In order to do the cash flow statement, what do I need? Proceeds. I need how much I've sold it for. So that's the one amount I need. Proceeds. And then the other amount that I need is the profit or the loss that you have made. Okay. So in that, when we had land, we had the proceeds, we had to go and calculate the profit. Now with this one, we have the profit, we need to go and calculate the proceeds. Okay. So I've got my two amounts there. I've got the profit of 74,900, that's going to adjust my profit, and then the proceeds, which will go into my cash flow. Then it says net gains on fair value adjustments recognized through profit or loss in the reporting period amounted to 120,000. So that would also be an adjustment to my profit figure. And then it says, the remainder of the movement in the balance resulted from the acquisition of new shares. I did not have to go and give you that last bullet point. You must go and make sure that the movements here explain the movement from 500 to 600,000. So please do not assume that when I've given you information, it's everything that has occurred in a balance. You still need to go and work from last year's balance to this year's balance with everything that has occurred. Okay. So to do that, we're going to say we have a balance of 500,000 last year. Okay. Then we had the sale of some of the investments at 250,000, so the carrying amount. And then what else influenced my balance was the gains of 120,000. So that's all the information that has been given to you. If I calculate the balance then, I get an amount of 370,000. While the balance in my statement of financial position is 600,000. So therefore the difference of 230,000 is an acquisition of investments. Okay, so in one of the videos that I have there on Blackboard, I call this the explaining the balance. So with a cash flow statement, you have to explain the balance, the movement that has occurred from last year to this year. And I'm going to give you some of the information, not necessarily all of it. So you must go and make sure that the information given explains the balance in full. Otherwise, you need to work out what is the difference. Okay. Right, so we are done with our non-current assets. So now we're moving on to my current assets. I've got inventory there. There's no note with inventory. So we will just be working out the difference from last year to this year. And that will go in my working capital changes. Then we have receivables there, and with receivables there's a note. We go to note 5. And it says receivables are presented on the statement of financial position, net of the allowance for expected losses or provision for bad debts. They also changed this name here. So it was 17,670 in 2016, and in 2015 it was 18,140. Okay, so there's two things that we have to go and do here. The first thing is that the movement in the provision for bad debts, what would have been that journal entry that you're going to do? From one year to the next, when you have to increase or decrease the provision for bad debts, what do? Let's say we're increasing it. Credit the provision, right? Debit bad debts. Okay, so there's no bank anywhere there. No cash or cash equivalents. So it's a non-cash flow item, therefore that movement must go, we will have to go and remove the movement from our profit before tax figure. Okay, so that's the one thing that we have to do. The second thing that we have to do is, because it's a non-cash flow item and it is now being included with my receivables, I have to add it back to my receivables. Okay, because I don't want a non-cash flow amount with my receivables. So remember, to get your receivables amount in your statement of financial position, what you would do is you will take all your debtors and you will deduct the provision for bad debts from that. And that is how you will show your receivables. So they've done that correctly, but now when we get to the cash flow statement, we don't want that. We want to add it back. Okay, so remember with the provision for bad debts, or whatever it is called, that you first have to, the movements in it must be removed from my profit before tax, and then secondly, I must go and remove it from my receivables. Okay, so that is with receivables, and that difference of 19,220 is a decrease, and that will show in with my working capital changes. Okay, then going back to my statement of financial position, so I've done inventory, I've looked at receivables, then I have prepaid expenses there, so that will just be part of your working capital changes. So you'll just work out the difference, which is 14,520, and that will go with my working capital changes, as I've said. Then we have receivables there. So last year, the receiver of revenue owed us money of 26,100. So when we get to calculate my tax paid, I just need to go and remember that they owe me money. My bank is the amount that my cash flow statement should balance to. Okay, I'm going to use that right there at the end. Then we get to our equity. We have ordinary share capital, and there you see we've moved from 2.3 million last year to 800,000, but we have increased our preference share capital. So let's go to note 6 and see what has happened there. So it says during the current reporting period, the following share transactions occurred. There was a share buyback of 600,000 ordinary shares at their book value. At the beginning of the 2016 reporting period, the company had a total of 920 shares in issue. So two ways that you could have gone and done that. Probably the easiest of the two would have been just to have a look at the difference here and say that it's 1.5. But it would be good to just confirm that nothing else happened with the share capital. So to do the share buyback, little calculation. And that amount will show up in your cash flow statement, buying back the shares. And then on the redeem of the preference shares, it was 500 shares times R1.50 a share. And then there was share issue cost. Remember, share issue cost is deducted from share capital, and that then gives me 725. Okay, so we've almost worked through everything. We've done share capital now. The preference shares is at 725, so there's nothing further that occurred there. Retained earnings, you will only go and use retained earnings if I haven't given you profit before tax. So please go through some of the question banks. There's some question banks where the profit before tax is not given and you have to go and calculate the profit before tax. Okay, so that's the only time that you will use retained earnings and cash flow. Then we have the long-term loan and movements that have occurred in the long-term loan. When you do have a long-term loan, just beware for the short-term portion as well. So when it comes to the cash flow statement, you need to add those amounts together, okay, so that you have the full long-term loan and work from there. So let's just see what has occurred with the borrowings. So we know about that 1.8, but just need to make sure that that was all that occurred. So I'm just going to do it here at the bottom. Go and explain the balance. So we had 800,000 at the start, we have 2.1. At the end of this year, we had an increase of 1.8, yes, and therefore the difference gives me 500, so that was a repayment of the loan that occurred. So therefore the loan is two amounts, there's the 1.8 that we are going to put in as well as the 500,000 repayment. Right, then lastly, we have here note 8, which is the debenture. The debentures consist of 12,000 debentures of 100 Rand each. These debentures were issued by Rainbow Limited at their fair value of 106 Rand each on the 1st of October. The debentures are all repayable on the 30th of September at their nominal value. Interest is payable on the 1st of October each year. The debentures are measured at amortized cost using the effective interest method, and applying this method, the interest expense for the current period is 228,135. This amount is included in finance cost. Okay. And it's correct that it's been included in finance cost. Okay. Now, think back our financial instruments. When we did either a financial asset or a financial liability at amortized cost, we did a little amortization schedule, right? That amortization schedule had two interest amounts in. So there was the effective interest, okay, and then we had a cash flow amount, which was the nominal interest. And what the effective interest increased the balance, right? And the nominal interest decreased the balance. Can you still remember that? Okay. Now, the effective interest is the one that will show in your statement of comprehensive income. So, like they've said there, it's part of finance cost. It's right. The effective interest is not the one that is being paid. The nominal interest is the one that is being paid. And that is missing. We need the nominal interest because we now need that for the cash flow statement. Okay. So, the effective interest, this interest paid, you're going to use this amount with your profit before tax when you make those adjustments. But what we need for the cash flow is the nominal interest that is being paid. Now, in this example, probably the easiest way to go and do that calculation is to go and just work with your balances, because I've got the balance at the beginning, I've got the balance at the end, I've got the effective interest rate, so the one that is missing is the nominal amount, and I can go and calculate it like that. But it might be that you will have to go and calculate the effective interest rates, the percentage. So every question is going to be different in that sense. Okay. So to do that, go to the balances in the statement of financial position that they've given us. So the balance at the beginning of the year was 1261951. If you think of your amortization schedule, we will then add the effective interest. And then you'll deduct the nominal interest, but I don't have that. I only have the balance at the end. So then, therefore, my balancing figure will be my nominal interest. Okay, so this was now a financial liability, but remember that we had financial assets and amortized cost as well. So the same principle will apply. I need the nominal interest for my cash flow as interest received that I need to go and show. Should I give you an example like that? Right, so we've done everything, all the work now. All that we now need to go and do is to physically put it into the statement of cash flows. Please remember that these are really important calculations, so I want to see them, so don't do them on your question paper, please do them in your script, in the exam, and just don't make a meal of it, but just be clear, so maybe call them C1 as for calculation 1 and give it a short little heading. This is borrowings that I'm busy with, and then do the calculations. Because we do refer back, for a cash flow statement, definitely we refer back to those calculations that you have done. Okay. Right, so let's go and write up the cash flow. writing the correct heading means that you are applying the principles of IAS 1, and therefore we will give you a mark for writing the correct heading, but it must be 100% correct to get that mark. So for instance, with the statement of comprehensive income, it must say statement of profit or loss and other comprehensive income for the year ended for you to obtain the mark. Okay. Right, so remember that the cash flow has 3 sections. So it's cash flow from operating activities first. And this is the indirect method. So we are going to start with profit before tax. And in the note 1, which we didn't look at, they provided me with the profit for the year. So not before tax, after tax. So I just need to add back the tax amount. So now we need to adjust this profit before tax for those 3 items for us to get to a cash flow figure. So the 3 basically headings is items appearing later, then non-cash flow items, and my working capital changes. It does not have to be in order. So if you get this all muddled up, it's fine, this part up until cash generated from operations. So please don't worry about getting it in the perfect order. So we adjusted it for items appearing later. I'm going to show first. That is finance cost. Okay, that I get from note 1. Okay, so the 2 items appearing later is my finance cost and my dividend income. And both of those I got from note 1. Do we put dividends paid here? Why not? Because it's got no effect on my profit before tax, right? No effect. It affects my retained earnings. So please do not put dividends paid here. Right, then I'm adjusting it for all non-cash flow items. So it's a lot of those items that we've highlighted in, what was it, blue? I think, yes, blue. Okay, so the first one is depreciation. Remember here we're busy adjusting profit before tax, so we do the reverse of what we would usually do. So as you can see, my income items I deduct and my expense items I add, because I'm adjusting. Okay, then we had impairment loss. That was on the development cost. Okay, so the first two were items appearing later, and all these that we've just done, these are non-cash flow items from all the calculations that we've done. And now we put in the working capital changes. So our inventory, prepaid expenses, trade receivables, and trade payables. Which one? Yeah, yes. Just there at the bottom, the working capital changes. The way to determine whether it's in brackets or not, the way that I do it is I draw up a quick T account. So I would go and say, okay, so I've got inventory and I've got bank. So if inventory increases, it means that it will increase on the debit side, and therefore resulting in a decrease of my bank. And therefore, increase in inventory is in brackets. Because what I'm concerned is the cash flow that have occurred. So that's what I would do with all of those, just to quickly go and work out what, if it's in brackets or not. Okay. Okay, so then after we have cash generated from operations, so remember, once again, if we were doing the direct method, we would have also come to this cash generated from operations, and now we will be doing the exact same format going forward. So after cash generated from operations, we show those items that we would say would appear later. Adding to, we add dividends paid and we add tax paid in here as well. So in this example, we have dividends received. And there was no further information on it, so that is the dividends that we've received. Because what we're looking for here is the cash amount. So it might be that there's a difference between the amount that we have here and the amount that we remove here at the top. Okay, so this is the amount that is included, this one at here. These two amounts, those are the amounts included in my SCI. They might not be necessarily paid or received in cash. What I'm looking for now is the cash amount. But with dividends received, there was no further information, and therefore I assume that was the cash amount. Okay. Then with interest paid, there's a slight difference here. So in my statement of comprehensive income, I have 381,300 for my finance cost. Included in that amount is 228,135. That is the effective interest of my debentures. But remember what we said, we don't want the effective interest, we want the nominal interest. So we add the 240. The effective interest, there was no cash flow with the effective interest, but the nominal interest is the cash flow. Why do I not only show 240,000? Because I can have other interests. Okay, I've got other borrowings. There will be interest on those borrowings. I don't just have the debenture that I have interest on. Okay, then we have dividends paid. Okay, so once again, I want the dividends that have been paid. In note 1, they have given me, note 1 here, they have given me the dividends for the year. Now that dividends for the year might not have been paid. Remember, I declare dividends and I don't always pay them right at that stage that I've declared them. So in order to get the dividends that have been paid, the cash amount, I have to take those two amounts, the 160 and the 15, and I also have to use this shareholders for dividends amount. Because the shareholders for dividends, that's basically what is still payable to shareholders. Okay. So this was the 2015 shareholders for dividends. So it said at the end of 2015, 55,000 was outstanding. I assume that I paid them during this current year. I add to that the dividends, the ordinary and the preference dividends for the year, which can include those that I've declared and not paid yet. And then I deduct the 2016 shareholders for dividends, because those have definitely not been paid yet. And that then gives me my 140 dividends that have been paid. I do the same thing for tax paid. Okay, so tax paid, same thing, the income tax amount in your statement of comprehensive income might not have been paid yet. So I have to go to my balances and see if there's any tax payable. Now remember in this case, let's go there, sorry. Remember in this case that we had a receivable in 2015 and in 2016 we have a payable. Okay, so we just need to take that into account. question, basically, when it came to the cash flow from investing activities and financing activities, we just wrote down everything that we've already calculated. It will be good exam technique if you, for instance, would just go and say, this came from calculation C3, so that we can refer back to that calculation of yours and we can see the amounts there and give you the marks or the principal marks that comes from that. Okay. There is a cash flow statement in the exam. Okay. So please go and prepare them well. They are between 35 and 40 marks, and there are a lot of easy marks in the cash flow statement for you to go and get. Please do not let the format be a stumbling block. So make sure that you know the format, that you have written it down a few times, that you have tested your friend on the format, and then go and work through the question banks. You really, truly do not have to go to the textbook for cash flows. Okay, so please, it's questions. You must work through questions when it comes to cash flows. Thanks, everyone. I'll see you on Thursday.
Stop. It's probably there. Was that there?
Hopefully it will stop here. No, the time is still going.
Button is there.
I think it's the same as the square you switched on. The little red one.
Oh yeah, probably here.
No, just now it won't save.
That's right.
What time is it?
Stop.
Let me just phone him quickly.